Stop buying pure-play quantum stocks. Seriously. If you're chasing IonQ, Rigetti, or D-Wave because you think they're the next Nvidia, you are making a dangerous bet. The counterintuitive truth that Wall Street is slowly realizing is that the smartest quantum stock isn't a pure-play company, it's IBM. While IonQ, Rigetti, and D-Wave are early-stage ventures with minimal revenue and no profits, IBM boasts a staggering $14.7 billion in free cash flow projected for 2025 and operating margins of over 59%. This diversified tech giant can afford to wait for quantum advancements, even if it takes another decade. They are investing $10 billion in quantum over the next 5 years, aiming to develop the world's first large-scale fault-tolerant quantum computer by 2029, all while recently securing around $1 billion in public funding and partnering with AMD to create hybrid architectures. In contrast, the pure plays are bleeding cash. Let's break down why IBM is the smarter quantum bet, and stay until the end for 3 secrets that will transform how you invest in emerging tech. I'll admit something, I too was drawn to the allure of pure-play quantum stocks. The thought of investing in a small company with huge potential was tempting. But when I examined their financials, I found a stark reality: no revenue, no profits, and a desperate reliance on investor capital for survival. Today, I'll illustrate why IBM's solid financials and strong commitment to quantum computing make it the superior choice. We'll explore the pitfalls of pure plays, the impressive $14.7 billion free cash flow, their significant funding for quantum, their roadmap to a fault-tolerant quantum computer, and the attractive 2.6% dividend that you earn while waiting for the technology to mature. By the end of this video, you'll understand why 21 analysts have rated IBM as a moderate buy, with a street-high target of $365. Let's begin by discussing the issues with pure-play quantum stocks. Companies like IonQ, Rigetti, and D-Wave face serious challenges. They are early-stage ventures with minimal commercial revenue, no profits, and they rely entirely on investor capital. The risk here is that if investor enthusiasm wanes, these companies could struggle to fund operations. Unlike Nvidia, Amazon, or Microsoft, which had profitable business lines to fall back on while developing new technologies, pure-play quantum companies don't have that safety net. The market has yet to fully price in this risk, ignoring that quantum computing is still at least a decade away from mass commercial adoption. Now, let's look at IBM's advantages. They're projecting a free cash flow of $14.7 billion for 2025, with operating margins exceeding 59%. Their diversified revenue streams include consulting, software, and infrastructure, which provide stability and funding for their quantum projects. This means IBM can afford to invest heavily in quantum computing, even if it takes a decade to see tangible returns. When you invest in IBM, you are buying a profitable enterprise that happens to be at the forefront of quantum research, as opposed to investing in a pure-play company with no backup or safety net. Moving on to IBM's significant commitment to quantum technology. They plan to invest $10 billion over the next 5 years, targeting the development of a fault-tolerant quantum computer by 2029. Currently, quantum computers are plagued with errors, but a fault-tolerant system would be able to correct its own mistakes, marking a significant step towards viable commercial quantum computing. Moreover, IBM has secured approximately $1 billion in public funding, showcasing that the US government is backing their efforts in this crucial area of technology. A key advantage for IBM is their collaboration with AMD, focusing on hybrid architectures that merge quantum systems with classical computing and AI accelerators. Quantum computing isn't set to replace classical computing. Instead, it will complement it, handling specific tasks while classical systems manage the rest. This partnership positions IBM uniquely in the market, offering a comprehensive solution that pure-play companies simply cannot match since they lack the classical computing expertise. Now, let's unveil the 3 secrets that link everything we've covered. Secret number 1 is the profitless startup trap. Early-stage companies like IonQ and Rigetti require constant cash infusions. If investor sentiment wanes, they face dire circumstances, unlike IBM, which generates its own capital. Secret number 2 is the patience dividend. With a 2.6% dividend, IBM pays you to wait, while pure plays burn cash without offering any returns. Secret number 3 is the hybrid moat advantage. IBM's classical computing business provides them with a significant edge in developing hybrid solutions that integrate quantum computing, creating a competitive advantage that pure plays lack. So, what should you do with this knowledge? If you're bullish on quantum computing, buy IBM. You gain exposure to quantum innovations while benefiting from a profitable enterprise and a 2.6% dividend. For income investors, IBM presents a quality value stock at 20.59 times forward earnings. And, if you are a speculator, while pure plays have potential for dramatic gains, they also come with the risk of losing everything if funding stops. Wall Street views IBM favorably, indicating it's a smart and safe long-duration tech bet. Would you rather own IBM, with its strong fundamentals, or speculate on companies like IonQ? Let me know in the comments below, and don't forget to like and subscribe for more insights on emerging technologies.